Good morning, friends. Welcome to our today's session. Today, we will be discussing about the recent most change in your financial reporting or your subject called accountancy, and that is introduction of IND AS, and we will be discussing IND AS 2 in comparison with AS 2, Accounting Standard 2, and that is inventory. Friends, those who are undergoing your intermediate or IPCC level, you must be well aware you are learning accounting standards and you have learned accounting standard 2, or you might be learning it in future, accounting standard 2. For the new syllabus at final level, we have Indian accounting standard 2, that is inventory. Now, what is the difference between IND AS 2 and AS 2? What is the overall change? What impact would it make in your financial statements? We will be discussing that here. Though I have written it as IND AS 2 in the note, as you can see, but I'll rest assure you will be also learning accounting standard 2. So this will be useful to both at intermediate as well as final level to understand the valuation of inventory, with what value you will record your stock in the books of account, and disclosures. Now before starting, friends, you people are aware books of accounts, they are prepared as per the relevant standards into the picture. AS2 deals with calculation and valuation of inventory. Now basically there are three methods or three types of businesses. The first one is known as manufacturer, the second one we call them as traders, and the third one are known as service providers. Now generally before AS2 or introduction of IND AS2, you people are aware that valuation of closing stock we used to follow the basic methods like FIFO, LIFO, average, weighted average methods, those who have learned at foundation levels. Now this is the method of valuation of inventory for traders. That means those persons who are merely buying and selling of goods. In case if you are a manufacturer or if you are a service provider, friends, service provider was not a part in case of valuation of inventory as per accounting standard 2. So as per AS2, we used to find out the value of inventory, or AS2 dealt with the valuation of inventory only for manufacturers and traders. It did not consider service providers. However, IND AS2 has also has widened its ambit and included the service providers also into the portion of valuation of inventory. So first of all, let us understand, friends. First thing what you need to understand is definition of an inventory or a stock. Generally, when we define the word inventory, the first thing that comes to our mind is the goods in which a person is dealing. Either he is manufacturing or he is selling the goods. In case of service providers, he won't be selling the goods, but those are the goods that are kept by him for providing output services. So basically, definition of an inventory. Inventory is something which is either manufactured for the purpose of sale or kept in the business, purchased by the business for the purpose of further selling, or it has been kept by the service provider for providing output services. Now this is a general definition. When you move to practical life, friends, there are certain complications which come into the picture. For example, what can be considered as a stock, what not can be considered, what all things will be included, what all things will not be included. So first of all, let us understand the inclusion or the scope of inventory. An inventory includes everything except, that means the list given above is a negative list. It includes everything except financial instruments in terms of shares, stocks, equity method based valuations, biological assets. Now this is something new. Biological assets, they are covered up with Indian Accounting Standard 16, that is plant, property and equipment, or Accounting Standard 10. Producers of agriculture produced and forex products. Now this was not a part in accounting standards. There was no specific separate accounting standards for agriculture produce or forest products. However, in Indian accounting standards, that is IND AS, we have got IND AS 41, which deals with agricultural products. So here we will be understanding what all things will be a part of agriculture, what all things will be a part of inventory, and what all things will not be a part of inventory. There is one more thing: inventories of commodity stockbrokers whose value or who value stock at fair value less cost to sell. Here we are talking about those persons who are dealing in shares, securities or debentures and such related items. Now on the right hand side, as you can see friends, we have already covered up this. What all things are included as a part of inventory? Inventories are assets which are held for sale in ordinary course of business. They are held for the purpose of production for further sale, and third, in the form of raw material that can be consumed during production process. The third point is applicable to a manufacturer. So friends, first of all, define that whether you are finding the valuation of a stock for a manufacturer, for a service provider or for a trader. After that, you need to determine the methods of valuation of the stock or inventory, which will be covered up further here in the video. First thing what you need to do is whether that thing qualifies as an asset under the definition of inventory or not. That's always your first step towards valuation. Do not straight away jump into AS2 or IND AS2. First define whether that inventory is a part of IND AS2 or AS2. After that, go for valuation methods. So this all things are inclusion and exclusion portion. Now what is the general definition or what is the general method of measurement of an inventory? See, inventory or stocks are generally valued at cost or net realizable value, whichever is less. Now this was the same in AS2, or this is the same in AS2 as well as in IND AS2. But the only point of difference is, friends, those who are learning IND AS2 or those who are learning Indian accounting standards, you are well aware there is a concept called fair value concept which has been introduced and which is the base of valuation in IND AS. Now this fair value has been substituted everywhere, majority of the IND AS, and this has created a dilemma as well as confusion. However, the concept is excellent. It has changed the valuation techniques. It has brought the financial statements to a more better picture. But here, let us understand it. In IND AS2, we are still dealing with cost and NRV, whichever is less. Now we need to define individually both. First, let us understand what do you mean by cost. After that, we will understand what do you mean by inventory. So definition of a cost is cost of purchase, cost of conversion and all other costs incurred to bring it to the present condition and location. Now friends, this is basically, as you can see from the definition, it's a more exhaustive form of a definition that can be used for a manufacturer. Because when you talk about cost of conversion, that is basically applicable to a manufacturer who is producing a goods. If you take an example of a shoe manufacturer, there is a company which is manufacturing shoes. Now you cannot say that the company would be buying shoes. The company would be buying raw materials that may be in the form of leather or any other raw material. Then they will convert that into goods and that will be known as shoes or slippers or sandal, as the case may be. Now see friends, your opening stock will be of raw material and your closing stock will be of shoes. So here three things play very crucial role. Cost of purchase of raw material, cost of conversion, that is converting the raw materials or those raw materials into finished form or into semi-finished state. And the third one is other costs that have been incurred to bring them into the existing condition and location. So from the viewpoint of manufacturer, valuation of cost plays an extremely important role. For that you have been learning costing techniques, you will be learning the methods of costing, different methods of valuation under cost accounting. Here we are not going to go that much deep into the methods of valuation. Just understand the definition of a cost. A cost includes cost of purchase, cost of conversion and other costs that are being incurred to bring those goods into the present location and condition. We will be learning each and every definition individually. First of all, let us understand what do you mean by cost of purchase. What do you mean by cost of purchase? Now purchase or cost of purchase includes first purchase cost, that is the cost of raw materials. Second, duties and taxes except those which are creditable. Now this is important friends, you will be facing this practically as well as from the viewpoint of your exam. Duties and taxes which are creditable, in the sense previously the word used was senvatable, that means on which credit can be availed. After introduction of GST friends, you are well aware we don't use the word senvatable, we use the word creditable. That means on which input tax credit can be claimed. Those things on which or those taxes on which input tax credit can be claimed will not be a part of your duties and taxes. And those duties and taxes on which ITC cannot be availed will be a part of your cost of purchase. And Other costs which are directly attached to the purchase of finished goods, raw materials and services, including transportation and handling cost. Now reduced by trade discounts, rebates and other similar items. That means in case if you are being provided with any sort of trade discount or any sort of rebate, that will be reduced from the cost of purchase. Now understand friends, cost of purchase and cost of conversion, these two are extremely important from the viewpoint of a manufacturer. First one we discussed here, and that is cost of purchase. A purchase includes raw material cost of purchase, other incidental costs that have been incurred to bring those raw materials to the existing factory, as well as it will include duties and taxes that you have paid, subject to condition that duties and taxes are not creditable. It will be reduced by the trade discount, rebates and other similar items. Now important one, and that is cost of conversion. That is to convert this into finished goods or into the semi-finished goods state. This includes material cost, labor cost, overheads. If I am not wrong friends, you have been learning this word overheads, but we don't use the word overheads in accounting, we use the word overheads in costing. Here we'll use the words other directly attributable cost, fixed and variable production overheads. Now understand this friends, cost of conversion. We'll continue with the same example, manufacturing of a shoe. A company is a shoe manufacturer. They are purchasing raw materials in the form of leather. Let us assume the company is only manufacturing shoes and it is manufacturing shoes out of leather. So it will be purchasing leather, that is cost of purchase would be the raw material cost of leather purchased plus direct taxes or other taxes, not the direct tax but the other taxes that has been incurred or paid which are not creditable, and bringing those raw material to the factory. Now those raw materials are being processed, being converted into the semi-finished or the finished goods state, which we called it as shoes. Now all those expenses which are being incurred to convert those raw material into the semi-finished or the final stage is known as cost of conversion. This includes material cost. This is not only the purchase raw material cost but also the other material which are being purchased along with the raw material. Your basic raw material is leather. Other purchasing materials may include glue, or the lace that you are tying, or the any other sole that you are purchasing. These are all a part of material cost. The labor involved for the human power or the manpower that is being used. If you are an electricity based or you are completely digitalized form of factory using no human resource, then there will be the other directly attributable cost. But if you are using manpower, there are laborers who are converting it into the finished goods, the labor charges that you pay, the wages that you pay, and the other costs which are directly attributable, which may include factory cost. If I am using the words of costing, it may include factory cost, certain administrative overheads that are directly being attributable for the production of such finished goods, electricity expenses of the factory, direct machinery depreciation that is being used in the factory. These are all the costs which are directly attributable to the cost of production. There may be fixed and variable production overheads. Friends, you know what do you mean by fixed and variable. I'll just give a small highlight definition. Fixed expenses are those expenses which remain same irrespective of the quantum of production up to certain level, to be very specific. Variable production overheads varies according to the change in the production. That means it will change according to every unit you produce. So variable production overheads majority of the time is always per unit base. That means for one unit, what is your variable production overhead? As soon as you increase the production of that unit from 1 to 2, 2 to 4, 4 to 8, your variable production overhead will keep on increasing. However, your fixed production overheads will remain same up to the certain level based on your normal production capacity. So variable production overheads, it is very easy friends. Suppose if you are manufacturing 100 pairs of shoes, you find out your variable cost per pair, multiply it by 100 and you will get your variable production overheads for that 100 pairs of shoes. Suppose your manufacturing increases from 100 to 150, your variable cost will correspondingly increase accordingly. However, fixed production overheads are not same. Fixed production overheads are charged based on normal production. So generally up to certain level of production, your fixed production overheads will always remain same. Say for example, your factory has a capacity of manufacturing 20,000 pair of shoes and you are manufacturing only 15,000 pair. Your fixed production overheads will remain same for 15,000 pairs of shoes also, because your capacity is 20,000 pairs of shoes and your fixed production overheads are allocated based on your capacity. but you are manufacturing only 15,000. So what you will do is you will find out the proportionate share based on normal capacity. So these two things are a part of theoretical portion here, friends. Your variable production overheads will always be allocated based on your per unit of manufactured product, and your fixed production overheads will always be allocated based on your normal capacity of production. These are a part of your practicals. Here I am covering up only theoretical portion. Friends, this video you can use it as a revision before starting your practicals of IND AS2 or even AS2. I can assure you this will be useful to both the levels as well as in your practical life. Just go through this, directly you can jump out to the practicals. Now we have covered up cost of purchase, we have covered up cost of conversion. Now the third one which we had seen in that slide, and that was other cost. Now see friends, this other cost is a debatable point. Why? Because other cost is a diplomatic term. We can use such type of expenses which you incur to bring the goods in the existing location and condition, or to be more specific, which is necessary to make the goods in a condition ready for sale. That means those expenses are necessary. Suppose a company is manufacturing cold drink. Now the company, once the cold drink gets manufactured, you cannot say that the company would straight away sell the cold drink. You need to manufacture the bottles or the cans or tins for storing those cold drinks. So that bottle, can or a tin, any expenses which are incurred for those bottles or cans can also be considered as a part of inventory, because they are an inevitable part of stock which are compulsory, because you are well aware your cold drinks cannot be sold leaf rolled, or they cannot be sold as loose rolled. You need to store them, you need to keep it in a specific product. So manufacturing and other expenses incurred for that product will also be a part of your cost of production. Now there are certain expenses which will never be a part of your other cost. Now friends, this is important. Remember the exclusion list, it will be easier for you. What all things will not be a part of your cost? First one is abnormal loss. Again I will take you to the subject called costing. Your abnormal loss or abnormal waste are always a part of costing P&L. That means it is a part of your expense. Similarly here, your abnormal waste or loss will be a part of profit and loss. However, if it is a normal loss, which is natural, which is unavoidable, such normal costs are always charged to production. That means it will increase your manufacturing cost. Abnormal loss are always charged to profit and loss. Storage costs, admin overheads and selling overheads. These four expenses are not a part of your cost of production. So whenever you are finding the cost, we are still discussing the cost. What was the method of valuation of inventory? Cost or NRV, whichever is less. Cost is made up of three things. It includes cost of purchase, cost of conversion and other cost includes. Cost of purchase we have discussed, cost of conversion, and here we are talking about the other costs that have been included. This other cost will not consider the four expenses. So this was your cost or definition of a cost for finding the cost of an inventory. Now the next one, friends, is known as net realizable value. We have found the cost. Cost is made up of cost of purchase, cost of conversion and other cost. Once you find the cost of inventory, keep it aside. Now find out your net realizable value or the NRV. NRV is the reverse procedure, friends. What is the formula for NRV? It is estimated selling price minus estimated cost of completion minus estimated cost necessary to make the sale. When you find out the cost, a cost is a hierarchical approach. Cost of purchase, cost of conversion, other cost. That means you are finding, you are approaching in the straight manner. You are moving forward. But when you are finding an NRV, actually you are moving backward. You are going to the selling price, that is the expected or the estimated selling price, minus estimated cost of completion and minus estimated cost necessary to make the sale. So you will come to the same point. Cost, cost of purchase, cost of conversion and other cost incurred. That will be your cost. NRV, estimated selling price minus estimated cost of completion minus estimated cost necessary to make the sale. So ultimately you are coming to the same level. Straight approach, backward approach. Out of this two, follow the conservatism approach. You know conservatism is the basic principle of accountancy. What does conservatism say? You will not be recording future profits, but you will be recording the foreseeable losses. So whichever is less, you will be recording it at a lower value. So if cost is less, cost. If NRV is less, you will be recording at NRV. That is your net realizable value. Now friends, let us understand if a company is manufacturing more than one products. We understood definition of a cost, definition of an NRV. Now suppose a company is manufacturing more than one products. So you got one option. If both the products are separately identifiable, that means you are incurring separate cost for both the products, then it is easy to determine the cost, it is easy to determine the NRV. You determine cost and NRV for the both and attribute it accordingly. There can be one more possibility. It might happen both the products are being manufactured in a single factory. That means there are certain variable and fixed production overheads which are common in nature. It might also be same, there are certain labor expenses which are common in nature. You might be using the common labor for both the products. A company manufacturing toothpaste and toothbrush, maybe they might be using the common labor as well as common expenses. Raw material cost may be different. In that situation also friends, that's not that much problematic. What you can do is find out the cost of one product, cost of other product. Now you would say, sir, certain expenses are common. Then I would say go to the costing. You've learned cost. Under costing you've learned joint product, byproduct, methods of segregation of cost of joint products and byproducts. Here we are not talking about byproducts, here I am talking about the joint products because they are manufactured together. Segregate the expenses, those 5 methods of segregation of expenses under costing. I will not be discussing those 5 methods here, but it's easy to aggregate those. But when I merge it with AS2, remember friends, costing deals with costing records. Here we are dealing with the financial records, and that too as per the relevant standards of accounting. So in case if you are manufacturing multiple products and if it is separately identifiable, you can see on the chart friends, if there are joint products and cost can be identified separately, you will allocate it based on the separate cost. But if cost cannot be identified separately, then you will be following the relative sales value method. So relative sales value method is one of the methods of costing that you used to use to segregate those joint costs at the stage of separation. That means you will segregate cost on the basis of separation. Now if you are manufacturing a byproduct, then there is a question friends, because see normally byproduct is something that is not being manufactured, but it comes free of cost along with the main products. So companies normally what they do is they do not manufacture byproduct, they manufacture main product and it comes complementary with the byproduct. Yes, there are certain companies whose byproduct is being sold more than the main product. It is having a relatively higher market share worth compared to the main product. So you cannot just simply ignore byproduct. Moreover, certain byproducts need to be valued separately. So if such byproducts are immaterial, that means that does not possess certain value. In that case, NRV of the byproduct is deducted from the main product, because see normally what happens is they are scrapped off or they are generally sold off in the form of scrap because they do not possess any value. In that situation, find out the NRV of that product and it will be reduced. It will go to reduce the cost of the main product. In the case if byproduct is immaterial, find out its NRV and that net realizable value will be deducted from the cost of main product. So it will go to reduce the value of main product. Ultimately it's a revenue against the expenses of main product. However, if the byproduct is material, then the question would come. Material, that means it has got a relative worth. There are certain processes which are being involved to increase its value. In that situation, you cannot call it as byproduct, but it is at par with your joint product. So we'll use the same method that you use for joint product. So be careful friends. Again, it is a manufacturing. If you are aware, FIFO, LIFO, average, weighted average, those all methods that you have learned at your foundation or your CPT level were used only for traders. AS2 specifically what we are learning here is to value the stock or an inventory of a manufacturer. Trader comes along with it, but manufacturer and those cases where you are producing more than one products, there are multiple products, there are main product as well as byproduct. So in case of a byproduct and if it is material, that means you will treat it at par with your main product. Now next one is materials and other supplies which are held in inventory. See friends, sometimes what happens is certain materials or raw materials are being cleared along with inventory. That means they are part of a closing stock. And if that closing stock is not being sold, now say for example you purchased a raw material for rupees 100 and that raw material is a part of finished goods, as such as a part of production. Now if that finished goods are sold at cost or above cost, remember friends, raw material you have purchased, that raw material is a part of finished goods, and this finished good, if it is sold at cost or above cost, then that raw material which is remaining in the stock, it will be valued at cost. So here raw material is indirectly related with your finished goods. If that raw material which is used in the finished goods is not sold yet but it's sold at cost or above cost, then any raw material which is remaining in the stock which is used in that finished goods will be valued at cost. But if that finished goods are sold below cost, that means that raw material which you are using in the finished goods, and if that finished goods is sold below cost, see generally friends, what happens is when a raw material cost is merged, is cost of conversion, cost of purchase, everything will fall under cost of finished goods. So ultimately your finished goods cost will increase compared to raw material. So what does this provision of accounting standard 2 or Indian accounting standard 2 say? That if your finished goods in which the raw material has been contained, if that finished goods is either sold at cost or it is sold above cost, then the raw material which is contained in that finished goods will be valued at cost. However, if the finished goods are sold below cost, that means they are not sold at cost, they are sold below cost, then the raw material which is included in that finished goods will be valued at NRV, that is net realizable value. So what happens is, if the finished goods are not sold at cost or above but they are sold at below cost, that means you are selling it at loss. In that situation, here we are not talking about the valuation of finished goods, we are talking how you are going to sell the finished goods. So if finished goods are sold at cost or above cost, then the raw material which is used in the finished goods will be valued at cost. But if that finished goods is sold below cost, that means you are selling it at loss, then the raw material which is contained in that finished goods needs to be valued at NRV. Now understand this friends, this is important for the valuation of raw material, taking into consideration the methods of valuation of finished goods. Now what happens friends, the next point is, for a manufacturer, initially you are finding the cost of that goods. So there will be raw material cost, cost of conversion, other costs that have been incurred. Now after that, when the inventory is valued as closing inventory, the inventory which is not sold will be your closing inventory. Okay. Now this is not going to remain your closing inventory for the entire life. In the nearby future you are going to sell this inventory. So when this inventory is being sold, the carrying amount of inventory sold in the period in which revenue is recognized, that means the year in which you are selling that inventory is definitely going to be sold above cost if you are going to have profit. So if you are selling it at above cost, you are incurring the profit, revenue is recognized in the books of account. The year in which revenue is recognized, the cost that was incurred in manufacturing those goods will be treated as your expense. So you incur your expense, manufacture your goods, and when it is remaining in the stock, it is valued as closing stock. Now when this closing stock is being sold, that is the year in which revenue is recognized, this stock, this goods will be, or the cost will be recorded in the books. So friends, I hope this is clear. When the goods or inventory are being sold, that is the year in which that inventory creates revenue, in that year itself the carrying amount of the inventory in the books will be recognized as expense, and any written down value to the NRV, that means any time when the goods are being written it down to the NRV, such loss will be recognized as expenses. So in short, if you segregate AS2, this was your theoretical portion of IND AS2 as well AS2, which I have covered up only up to specific level, retail cost, standard cost, there are different methods of valuation. I have treated this only for the viewpoint of manufacturing as well as the valuation of inventory for a manufacturer. I will be talking about service provider, but before that, cost or an NRV, method of valuation of an inventory, whichever is less, cost of purchase, cost of conversion and other costs that have been incurred. NRV, that was a reverse approach when you are using manufacturing joint product or a byproduct. Be careful friends, NRV, method of valuation of an NRV, and the year in which the closing stock is being sold, the carrying amount of such inventory will be treated as an expenses. Now the main point of difference between AS2 and IND AS2. Now friends, see, first of all, When you talk about stock of a service provider, majoritarily the stock was not being valued in AS2, or AS2 was silent with regard to this. However, IND AS2 deals with regards to the explanation. Normally the closing stock of a service provider is valued at cost. Remember this, friends, it is majoritarily valued at cost. He is not going to sell it, he is going to use it for providing output services. The second one is machinery spares. Friends, AS2 was very much specific in regards to this. It does not include any spare parts or servicing equipments of a machinery. Now this was classified as per AS10 because AS10 was very much specific in this. Any spare part or an inventory which was a part of a machinery was always classified under AS10 and it was not a part of AS2. However, there is no such explanation which has been given in IND AS2. Machinery spares still continue to be classified as a part of AS10. Now, stockbroker commodity or commodity of a stockbroker, shares, securities and exchanges. Now, it does not apply. IND AS2 specifically ignores and says that it does not apply to the shares which are being held by a commodity broker who is dealing in shares. However, AS2 was silent. That means it was not considering anything. And subsequent recognition, which we have discussed last, friends, that in case of subsequent recognition, majoritarily you recognize it as an expense in the year in which revenue is created. Now AS2 was silent in regards to this. That means AS2 did not consider anything with regard to the future valuation or recognition as an expense. Now this concept, friends, NRV, has also been converted or has merged out with this concept of fair value, friends, in IND AS2. Now that is from the viewpoint of practicals. AS2 was dealing with NRV, that is net realizable value. However, IND AS2 was dealing that NRV along with the fair value. Now, simple definition of a fair value is the expected amount that you incur to settle the liability or the amount that you expect to receive in a normal course of business. Now, that is somewhat different than an NRV. In IND AS2, this NRV has been merged with fair value concept. However, that was not a part of AS2 and that is the only difference. Because you cannot say NRV and fair value both are same. NRV is the expected selling price in the market that is compared with the expected value of sales. However, fair market value is a settlement of obligation in the expected amount that you receive to settle an obligation or in a normal course of business. These two things are different. Fair value compares with NRV in IND AS2. AS2 deals with only NRV. This is the difference. However, all of your reference material, majority of the books, you will find IND AS2 and AS2 to be dealing under the similar standards and norms. Rarely you will find any sort of difference. But friends, I made you clear this. This was the basic difference, and the main difference that I told you was with regard to the valuation of NRV and the fair value concept. Friends, fair value play a very crucial and an important role as per IND AS, and majority IND AS takes into consideration this fair value part. There is a separate IND AS for the fair value concept, and recently the institute came up with certain clarifications with regards to the valuation concepts under fair value. You can find it on the institute's website, but that's useful only for your higher studies, for those who are dealing in the practical life. Now, this was merely a small intro gathering of AS2 and IND AS2. Friends, go through this video before your examinations. After that, go for your practicals, apply this theoretical portion. I hope this will be useful to you. Further queries, you can definitely contact me. I have given you my details. Thank you.